D.
D is for dividends.
Yeah, we were going to say D is for dog. It was actually suggested that. And that's actually not too stupid because I do get asked, I just thought before we go on to dividends, I do get asked about whether your dog can be a tax deduction. And, if it's a working dog on a farm, well, yeah, probably. You probably haven't paid much for it, to be honest, but you probably would be, buying it a bit of dog food. But a lot of people, particularly tradies, they like to have their dog go to work with them, and they might sort of be there on the back of the ute and they want to claim that dog as a tax deduction, and unfortunately you can't do that. Only time you can claim a dog as a tax deduction is if its entire purpose is to be essentially a security type dog. That means it doesn't come and sleep on the bed with you, doesn't come into the house, isn't used as a pet in any way. And clearly if you've got your dog on the back of your ute while you're out at a work site, I'm sure that dog gets a bit more attention than a security dog would at somewhere where they're, what I mean?
Might get a few more pats throughout the day.
Yeah. and part of the issue is how do you actually proportion its work-related purposes versus its non-work-related purposes? What is its actual work-related purpose when it's going to work with you as a tradie? I don't know. I have heard people say, well, it mines my tools on the back of my truck while I'm working. But again, how would you define that and proportion that?
Exactly right.
So, all right. End of D is for dog but, if you are one of those people who think that you can claim your dog as a tax deduction, probably not. D, however, is for dividend.
All right, so where would you like to start, Jo? Should we start with what actually is a dividend?
I think that's a great place to start. Do you want to say what a dividend is?
I'll say what a dividend is. So I got this from the ComSec website. Mm-hmm. So they said that a dividend is when a company makes a profit, it can choose to either retain some of it for future expansion and growth, or it can make a dividend payment to its shareholders.
That's a good definition. I do like that.
Thank you, ComSec.
Thank you, ComSec. Okay, I just want to clarify it's not really a difference, but a lot of people do get confused between the difference between a public company and a private company and a dividend that is paid. And there is actually really no difference, but a public company is someone like Commonwealth Bank or Telstra or someone like that, a big company that has lots of shareholders. And a private company is something like what we all trade out of as business owners, or not all of us, but a lot of us do. A private company means that it might have only one or two shareholders, just a few shareholders. We're using this as our business entity. Dividends only relate to companies. So if you're trading as a sole trader, a partner in a partnership, or out of a trust, you are not going to have dividends. You might have them from having an investment somewhere else, but your business is not going to generate dividends. So just be aware of that. We're only talking about those people who trade out of companies. And dividends are based on a couple of things. So to be able to pay a dividend, as your definition said, you must have retained earnings. And so that's really the most important thing. And then we need to determine whether that dividend, if you are going to pay it, is franked or unfranked. And for that to be the case, we have to have franking credits.
Exactly right.
Now, do you want to try and explain franking credits?
You go for it, Jo. I'm sure you'll do it much better than I will.
Sorry, I don't mean to take over here.
No, go for it.
It is something that I do spend a lot of time trying to explain to clients, and it is very tricky and trying to get your head around it. So franking credits mean that the company has paid tax at some point in time, and for it to be able to pay a franked dividend, you must have franking credits. So how does the company pay tax? Well, typically they lodge a tax return and they've made income and they pay tax on that. So in your tax return, if you do have a company tax return that you're doing, you will see that there's actually a franking account in your tax return, and it will say how many franking credits you have. So when we do a company tax return, we go in and say, what tax have you paid throughout the year? And we accumulate those franking credits. So there's main way you pay the main way you would accumulate franking credits is 1, paying income tax. 2, you might pay PAYG instalment in advance for your income tax. They all add up to your franking credit account. And the other way is you may be a company that also is investing with another company that is paying you a franked dividend, in which case that frank credit gets added to your franking account as well.
So, Jo, what happens when, say, for an individual, say, for example, if I hold shares in Telstra and I get paid a franked dividend and I receive a franking credit from Telstra, what happens with that when I complete my tax return as an individual?
Yeah, okay, good question. So what that means is in your tax return, and this is why people are very interested in frank credits, in your tax return, and this is the same regardless of whether it's a private company dividend or a public company dividend, whoever's got it will receive, so let's say that you got $100 worth of dividend. On that $100, there will be a franking credit. So you might physically get $100. I should have used 70 because 70 is easier. Let's say you got $70 worth of franked dividend. You physically got $70. That $70 will have, if it's a franked dividend from a public company, it will have been taxed at 30%.
Because that's the standard tax rate.
That's the standard tax rate for a public company. It's different for a private company. So we'll talk about that in a second. So that $70, for that company to have made that $70, it must have originally made $100 and then it had $30 tax come out of it to leave the $70.
Yep.
So just a basic maths, thinking about that. So they've paid you the $70. In your tax return, what will happen is not only will the $70 get put in as taxable income, so will that $30 franking credit. So you'll now have $100 worth of taxable income that you'll pay tax on in your tax return. But you will then get a credit for the $30 of tax that the company has paid. So while you're paying tax on $100, you are also getting a $30 credit, which means that you're not really paying full amount of tax on it in your own name because that company has already paid some of that tax for you. Now, if your marginal tax rate is higher than 30 cents in the dollar, which probably is the case for most people, you will have to pay the tax on the difference. Mm-hmm. If it's lower than that, so let's say you're on a, say, 21 cent tax rate, which means you're earning less than $45,000, you'll actually get a little bit of that 30% tax back.
So we quite often see, older people that are maybe just on the pension and have that low taxable income. We do see them get that tax back from franking credits. So we do have a lot of people that do use it for tax purposes as well, of course.
Definitely. So that's why retirees are very interested in holding shares that have good franking credit or good franked dividends paid on them. The other place that's very keen on that is self-managed super funds. So a self-managed super fund has a 15% tax rate for assuming it's a complying super fund. If the super fund is actually in full pension phase, it actually pays zero tax. So it will get all of that franking credit back. So I know that this has been an issue with governments before. They've tried to stop us having franking credits, etc. But that is why they're quite valuable.
Exactly right.
But a company doesn't have to pay a frank credit. It can also pay an unfranked credit. What do you think the difference is?
Well, with an unfranked dividend, there would be no franking credit, so you would need to pay tax on that unfranked dividend at 100%. So say, for example, if I got a dividend of $70 from Telstra and it was fully unfranked, that would be $70 added to my taxable income.
Yeah, and I did say an unfranked credit, I meant an unfranked dividend.
Yeah.
Sorry.
All good, I knew what you meant.
Just clarifying there with me saying the wrong thing. Yeah, so why they would pay unfranked is potentially they don't have the franking credits for it, or they want to be saving them for some other reason. There's a whole lot of theory behind all of that. But particularly if you're a private company, so let's go back to being a private company, so a tradie or any kind of small business that has its own private company, we're keeping track of that franking credit, but we may need to pay you more than what we have the ability to pay dividend out of that. We still have retained earnings. So for us to pay a dividend, we must have two things. We must have that retained earnings, and we can only pay a franked dividend up to the franking credit, but we can actually pay more than that if we've got the retained earnings, and it will be unfranked. So something to be careful of, just to understand that there is a difference between a franked dividend and an unfranked dividend.
Yeah, and I think it's also important to know that if you are investing in public companies, not every public company pays dividends as well. So if you are wanting to invest for dividend purposes, if you want to take advantage of that, just make sure you are investing in companies that actually pay dividends.
Yeah, and a lot of the spec companies, like the speculative companies, won't pay dividends. So a lot of the mining companies, and I'm probably not talking like, Rio Tinto or something like that, but or BHP, but the sort of smaller mining companies, they aren't at a point yet where they've actually made enough money to pay a dividend. They're getting like the reason you buy shares in those companies is so they can raise capital, so they can then build their assets and buy their assets, but they may not yet be at a profitable position to be able to pay those franked dividends out yet. So just be aware of that. There are other businesses that will actually prefer to pay unfranked dividends, and it could be because again, they may not be paying tax on their profits. So some things that can affect your ability to pay tax on your profits could be things like higher depreciation rates, or maybe some sort of R&D credit that you might be getting that's actually not increasing your franking amount but increasing your retained earnings. So, the dividend can be based on a book profit, not a tax profit. They don't always align to each other. I know I'm getting into complicated stuff there, and I don't expect anyone to really understand that, but there is the ability. So if you are looking at investing in a share, have a look and see what sort of dividends it's paid in the past. Have a look and see if it's paying franked dividends or unfranked dividends, or a combination of the two, and that will probably inform you what they're going to be doing in the future as well.
Exactly right. So if you are investing in a company that is paying dividends, some companies also have the option of a dividend reinvestment plan as well, just to make matters even a little bit more complicated. So not every company offers this, but some do. So you can choose to receive that dividend. If they do offer it, you can receive that dividend as cash. You can then opt into their dividend reinvestment plan, which means rather than receiving that dividend in cash, they give you that in shares of that company. And often they will do it at a discounted rate to entice you to keep building that share profile with them.
A lot of confusion happens there with taxpayers who do the dividend reinvestment plan, because you still have to declare that dividend in your taxable income, and you will still get the franking credit and all that sort of stuff if it's a franked dividend, but just because you don't have the money doesn't mean you don't have to declare that income. So it will still come up on your pre-fill, assuming that you've told the share registry who you are and that what your tax file number is. It will come up on your pre-fill, and you will still have to pay tax on it, essentially.
That's right.
Just on that, just another thought on that. When you do buy a share in a listed company, you will have to declare what your tax file number is. If you choose not to do that, what will happen is they won't know. So they won't know who holds the shares, first of all. But if you have an unfranked dividend paid to you, they will withhold tax on that because you haven't declared your tax file number. We can get that back when we put it in your tax return. That's fine. But I would suggest, if you are buying shares in a listed company, that you do fill out the necessary paperwork. Tell them what your tax file number is. It will make it so much easier when it comes to doing your tax return. And they won't withhold tax on your franked dividends, but they certainly will if you've got an unfranked dividend and you haven't told them who you are.
Exactly. It will certainly make life a lot easier if they have that information.
And just one more thing before we finish up on dividends is we talked about private versus public companies. Public companies are typically taxed at 30% on their profits. Most private companies are taxed at 25%. So if you are getting a franked dividend from a private company, the franking credit will be at a different rate to what you would if you were getting a Commonwealth Bank share dividend. There are some exceptions to that, and I'm certainly not going to go into that, but if you are a trading small business, private company, it is most likely that your franked dividend is going to be at 25%, not at 30%, which means you won't have as high a franking credit, but you also won't have as much. The income may be slightly less as well on that money that you have been receiving from the company.
Very good.
All right, it is a very difficult part to understand. The things that you need to remember when you're getting a dividend is it means your company, that whichever company, whether it's public or private, has made money, has got the ability to distribute some of that money to the owners of the company. They may have a frank credit to it. They may not have a frank credit to it. That owner will declare that income in their tax return. They will declare the grossed up earnings from that dividend, and they will get a credit for the franking credit if there is one attached to it.
There.
Now you're all confused.
There we go. Hopefully you all know about dividends and franking credits.
Yeah. Is there anything else you can think of that we need to talk about?
No, I think that pretty much covers it all.
All right. I would suggest that if you are thinking about drawing a dividend out of your company, please talk to your tax agent about it, or your business advisor. They should have a pretty good understanding of how it works, and they can help you.
Definitely.
All right. I think that's all for today.
I think that's all for today.